So on June 17, Kevin Warsh chaired his first meeting of the FOMC. The rate decision itself was unremarkable. It was a unanimous hold of the target range at 3.5 to 3.75%. Everything else, though, marked a regime shift. The first signals were in what the Fed chose to say and not to say about policy. The statement shrank from 341 words to 130. The easing bias was dropped. The dot plot flipped from showing one cut to a projected hike this year. And in the presser, the chair offered virtually no forward guidance other than an emphatic focus on price stability. The second set of signals were about the institution itself. Chair Warsh announced 5 task forces to review the Fed's communication practices, its balance sheet, its data sources, its inflation framework, and the impact of AI and other technologies on productivity and jobs. To me, the message was unmistakable. This was the opening act of a very different Fed. And I'll say up front, I've long believed that Kevin Warsh is the right choice for this moment. The Fed needed a chair who understands how to sustain institutional credibility in this environment when the system is under unprecedented stress. Someone who knows when and how to deploy its most potent tools, who has the savvy to build consensus within the Federal Reserve System and across political parties. I should also mention up front that at PGIM, we've predicted out of consensus that the Warsh Fed will hike the policy rate 75 basis points this year. The June meeting deepened our conviction about the direction of travel for policy, but the timing, the pace, the magnitude, the duration of the policy shift, those remain open questions for us. And that's why I wanted to invite Jim Bullard to the show. Jim is one of the most consequential monetary policymakers of the past 2 decades. As president of the St. Louis Fed from 2008 until 2023, he served on the FOMC through the financial crisis, through COVID, and the worst inflation outbreak in 40 years. He famously argued in late 2021 that the Fed was behind the curve, while the committee was still calling inflation transitory. Jim is now the dean of the Daniels School of Business at Purdue University. It's a change of address that has not dulled his appetite to say sharp things about the institution he served. Thanks for joining the show, Jim.
Thanks very much for having me. Looking forward to it.
So, Jim, let's start with the most basic interpretive question. We've had one meeting under Chair Warsh, 130-word statement punctuated with clear emphasis on price stability, a dot plot that flipped towards hikes this year, 5 announced task forces, and virtually no explicit policy guidance in the presser. Markets have read the meeting outcome as hawkish. The Fed funds curve now prices about 35 basis points of hikes before year end. Are markets correct?
I think they are. I think the committee has moved in a more hawkish direction. I've long felt that the chair position is not as powerful as people think. The chair can't just dictate policy. The chair has to maneuver within the middle of the committee, and the committee has clearly shifted in a hawkish direction. I think with core PC inflation running over 3%, that's beyond a red line for the committee, and they're still hoping, I think, that inflation will come down, but it's looking less likely without action. So I think the market has this about right.
Okay, so Jim, let me press you on the character of underlying inflation. The committee revised up its year-end core PCE projection by 60 bips to 3.3%. And core PCE is no longer projected by the FOMC to hit 2.0% within its forecast horizon. I read this as a recognition of structurally hotter demand growth, powered by drivers that are not highly sensitive to policy rates or energy prices for that matter. I'm talking about AI CapEx and the downstream lift to wealth-driven consumption. And this demand side boom is colliding with a set of supply side shocks that are not mean reverting and are not independent of each other. So tell me, what's your diagnosis? What's driving inflation? How persistent is it? What's it going to take to get back to 2.0%?
Well, it's probably going to take rate increases. I think the committee has, was too high last year, and they did point to the weakening, or apparently weakening labor market in the second half of last year, and that was grounds for the 75 basis point reduction that occurred last year. But as we got into 2026, it's become clearer that the administration's policies are pro-growth. The labor market has firmed up compared to what was expected, and that has left only the inflation side of the mandate being missed. I think it says a lot that the committee expects, even under good policy, to only hit 3.3% on core PC inflation at the end of this year. And that will be many years in a row of misses. So they've misplayed the end game here a little bit. I think we did a good job in 2022 and 2023, and inflation came down dramatically. But they haven't been able to get all the way to the 2%. So now they're going to have to redouble efforts. And I think the committee did have to take a hawkish stance here at this June meeting, although markets will test that and see if the committee's really willing to go to an actual rate increase as opposed to threatening rate increases.
You mentioned that the inflation readings that the Fed looks at most closely have now overshot the target for many years running, more than 5 years running. What does that suggest to you about the timing, the pace, the magnitude of any rate hikes that we see this year?
The end of year projection, 3.3%, already incorporates the idea that you'll get relatively benign ratings through the rest of this year. The analysis I've seen said 0.2 on monthly readings, through the rest of the year. It strikes me that if a couple of those don't come through, then you'll get even higher core PCE reading at the end of the year. So I think there's a lot of upside risk here that might force the committee's hand. And usually in this situation, acting sooner rather than later is a good idea. Because if inflation does rise to 3.5% or above 3.5%, it's going to take a long time to get that down, and you would have to have a more concerted tightening campaign. So the committee's at a crossroads here, and I think the sentiment has clearly shifted to more worries about inflation.
Would that also suggest, Jim, that since the labor market does appear to be stabilizing, maybe even accelerating, the committee could, in a sense, afford to move earlier and faster without risking outsized slippage relative to the employment target?
Yeah, I think one of the things that's being said is that this is more like the Greenspan Fed, and I sometimes would cite Greenspan as being a little more a little quicker to move and a little more impulsive, and maybe more willing to take a surprise move. Kevin Warsh has approvingly cited the Greenspan era, and that would be a change, I think, from the post Greenspan era, where, especially under Chair Yellen, Chair Powell, we got a lot of very well telegraphed moves. Even Bernanke, the Bernanke tightening cycle, extremely well telegraphed. And maybe that's not always exactly the best policy. And so if Kevin wants to go more in the direction of, hey, the latest data have come in pretty hot and we're just going to move right now, even though we didn't really prepare markets as much as the previous chairs would have, maybe that's what's in store here. But it would be a more volatile outcome for traders in fixed income for sure, and even across the board.
Okay, so let's talk about forward guidance. Chair Warsh has argued for years that the Fed overcommunicates, that forward guidance creates a sort of circularity in which markets price the policy path the Fed has signaled, which drains the information value out of the yield curve and potentially ties the committee's hands in ways that produce worse policy outcomes. You've spent 15 years inside a committee that built its operating model around forward guidance, state contingent projections that are designed to shape expectations. So I'll just put it to you directly. Is Chair Warsh doing the right thing? And what does it cost the Fed um, to give up guidance in terms of front-end volatility, the transmission of policy to the economy, and global spillovers? What are the trade-offs?
Yeah, I can give some examples. So I am kind of sympathetic to Kevin Warsh that he says, well, you telegraphed so much that the committee felt trapped at times, that they had to deliver, even in cases where the data had not really come in the way that it was projected to come in. And I think in that situation, I think the committee did make some mistakes. One was at the December meeting in 2016. At that meeting, the committee raised the policy rate and then projected further rate increases during 2017. It got a bad reaction, especially to the projected increases in 2017, and that led to everyone's forgotten this now, except for maybe this audience remembers this, but there's a lot of volatility January, February, March, and then everything was corrected in March. So it can all be managed, but that was sort of an unforced error, I think. And then again in 2018, the December meeting, you had the Fed having projected all year that they were going to do 4 rate increases, and then the data wasn't really cooperating in November and the run up to the December meeting. I advocated there that why don't we just delay this till January and see how this plays out? But the committee, I think that's a clear case where the committee felt we have to follow through, and they did follow through. And then you got a very volatile Christmas, and Jay Powell came out in January at the AEA meetings and basically changed the path of policy at that meeting or at that event, and then and the committee went on a different path in the first half of 2019. So everyone's forgotten these things, but I think those were cases where it's sort of over communication, over planning, and not enough reaction to not enough attention to the idea that the data didn't really corroborate what the committee was hoping for, and you probably should have at least delayed. I think Greenspan would have delayed at that meeting, that 2018 meeting, just said, well, we're not quite sure the data's consistent, so we'll just wait till January. I think we could have done that there and avoided a lot of volatility in markets.
And let me try to put a fine point on the risk of a very different approach. So when the Fed offered rich, let's say, revealing forward guidance, the reaction to any single data release was cushioned by the Fed's signals about the likely policy path. When you take that cushion away and every CPI print, every jobs report, every speech by a Fed official lands with greater force, especially in the early going of a regime in which investors don't really have enough data points to see the pattern, what do you see as potential consequences or trade-offs, at least on the front end of the curve and maybe the transmission of policy?
Yeah, I think that will also create more volatility. That's a little bit different, I think, because the Fed is not describing its reaction function as clearly as it would have before. And so markets are left guessing how the committee will digest that particular data point. And I think we did have that in the Greenspan era when the Fed was less transparent than today. That's why I've always advocated that it's good to have a big committee and it's good to have people more or less talking all the time, because then when the data comes out, somebody on the committee gets asked, what do you think about this data point? And they say, well, just one data point, and here's the overall picture. But that's a way to keep markets in sync with what the committee is thinking instead of guessing. So I think the art for Kevin Warsh is to get the right amount of communication so that you keep markets in sync with what the committee is thinking, but you don't over commit and feel like you have to deliver even when the data hasn't come in consistent with your plans.
You're almost pointing to an optimal amount of cacophony that can, suppress the amount of guessing and unwanted volatility. Uh, let's talk a bit about the long term and the task forces. Arguably, this was the announcement that may have the most lasting consequence to the institution. Our listeners know these task forces will cover communications, the balance sheet, productivity and jobs, data, and the inflation framework. And Chair Warsh said, look, the charges start with first principles, ask hard questions, examine current practice, consider alternatives, propose next steps. And these are all topics that have been treated almost as settled at the Fed for many years. Um, you were inside the institution when many of these frameworks that exist now were built. Are there any of these task forces that you consider to have the most potential to change the way the Fed operates, or which one are you focused on most, if any?
I think they're all important. I think even people inside the Fed feel that all of these issues should be um, uh, re-examined, thoroughly re-examined. And so this is a good best practice, I think, for any organization. It would be a mistake, though, to think that nothing's been done up till now. I mean, these things have all been pretty much continually discussed. They are treated as settled topics, but they're not settled. So communication, I think, was probably the key one. And there has been dissatisfaction across the board about communication, I would say. Yeah. Excuse me.
So let me press you a bit on the forward average inflation targeting framework. You know, uh, there are some who've argued that the flaw of FAIT, was it was built for a certain kind of world, a low inflation, zero bound trap, and that framework was problematic when the problem flipped to high inflation almost within days of the rollout. And you've talked about the appeal of a regime-dependent framework, that spells out 3 different states of the world, a Volcker-style response when inflation is running hot, the makeup approach when you're at the lower bound, and then an ordinary type of rate-setting process when you're in between. Uh, so a couple of questions. One is, do you expect that Warsh's inflation framework task force might end up with the type of regime dependent approach that you described and advocated for? And second, maybe this is a harder one. If your regime dependent framework were in place today with core PC at 3.4%, what regime are we in?
We're in the Volcker regime, so you have to respond strongly in order to get inflation back down to 2%. And the committee did that in 2022 and 2023, and now it's facing a milder challenge to that today. But the question is, and what happens when there's a gigantic shock and interest rates go to zero? And then how are you going to conduct policy in that world? And I think the overwhelming tendency of both among commentators and people inside the Fed is to kind of wish that that wouldn't happen or pretend that that's not going to happen again. And, gosh, we were in that situation for 10 years. Is it really appropriate just to wish that way? So I think the committee could do more to say that, look, if we've got something like the pandemic or the global financial crisis again, and at some point you will, then this is how this would be our toolkit for that situation. And that's a little different from the situation where inflation's above target. So I would like to see that. I'm not too optimistic that we're going to see that. The most recent framework review basically went back to a more plain vanilla description of monetary policy when inflation is very close to target and you're just sort of going along pretty close to steady state, and it doesn't really talk too much about outlying situations.
let me offer another situation in which the Fed might ease rates, not to the lower bound, but from the current setting. And that's if the Doves case for a disinflationary productivity boom plays out. And, the textbook claim is that the AI productivity upturn is going to lead to more output per worker, lower unit labor costs, lower inflation. That's what the theory says, but it's not yet what the data show, not while we're deep in the AI CapEx build out, in which supply constraints are hitting, skilled labor constraints, water constraints, power constraints. And you can see in the inflation readings that we're seeing, very significant price increases in categories like software and accessories. So I want to ask you, do you think the textbook claim that the AI productivity boom could be missing the microeconomics of how this could play out? Frontier chips are being provided by essentially one company. The cloud
I think
provider.
this is an important theme markets have picked up on. The tendency has been to talk about the oil shock and how the oil shock feeds through the price matrix and sort of distorts the price matrix. But I think the same thing is happening with the AI boom. So I think this is a good discussion to have. That's not really a fundamental cause of inflation because the Fed could react to that. But, that's sort of where we're at. And I think it's that another thing about the AI boom is it's so gigantic. And people sometimes forget that it's not quite the same as other things, but just gigantic. And now another trillion being expected for data centers next year. It really seems overdone. It seems like global crossing, and markets are picking up on that, I think, especially just in the last month or so. And they're kind of wondering where the returns are going to come from.
Fair enough. Well, I guess that's why we have a task force for it.
Yeah.
Okay, let me get you out of here with the question I ask every guest, which is, what's a consensus belief in your world? And you get to define your world however you'd like: macro, monetary policy, the Fed itself, that you think is just flat wrong. And maybe give me one that you think would get you funny looks in the room, just to spice it up.
The narrative coming from Silicon Valley that you're going to have a major productivity improvement, which is going to destroy jobs, flies in the face of all the other technology that has ever been introduced to the U.S. Economy, including most prominently agricultural technology, which changed the number of workers on farms from 50% to 2%. That didn't mean that we had 48% unemployment. It just means that those people went to do other more productive things than pulling weeds on the farm. So I think Silicon Valley is brilliant in some ways, but their understanding of macroeconomics is extremely limited. And they've had trouble communicating the idea that AI is going to be a great productivity improver, which means the standard of living would go up in the U.S., not that somehow labor doesn't get used effectively in competitive markets. So I think it's unfortunate that the AI debate has gone in this direction because it's a great technology, and you don't want people saying, hey, this might kill people or this might destroy all these jobs.
So, Jim, that is an optimistic way for us to end. I think many would follow up by asking whether you would expect a disruptive transition before we get to long-term job growth from AI. But let's end the episode on that positive note. And thanks again for joining. Let's keep the dialogue going.
Great, thank you. Really enjoyed it.
Past performance is not a guarantee of future results. Views and opinions expressed may not reflect PGIM's and are subject to change. This podcast is for informational purposes only and is not intended as investment advice. References to specific companies are for illustrative purposes only and should not be interpreted as recommendations to purchase or sell securities. PGIM and its affiliates may hold positions in the securities of companies referenced herein. This is not a solicitation. Please visit pgim.com for important disclosures and additional information, including details on non-U.S. jurisdictions. Prudential Financial Inc. of the United States is not affiliated in any manner with Prudential plc, incorporated in the United Kingdom, or with Prudential Assurance Company, a subsidiary of M&G plc, incorporated in the United Kingdom. Copyright 2026 Prudential Financial Inc. and its related entities. Prudential, PGIM, the Prudential logo, and the rock symbol are service marks of PFI and its related entities, registered in many jurisdictions worldwide.